Hello, everyone, and welcome to the March edition of Market Compass. It certainly has been an eventful month in markets, and today I thought I'd go through two key drivers of markets in recent weeks. First, we can review the status of the unfolding banking upheaval and the implications there. And second, we can discuss the March Federal Reserve meeting and rate hiking decision, as well as our broader take on markets. So first and foremost, most recently, while there has been a bit more stability in the banking sector, uncertainty remains and confidence is fragile. Notably, with the UBS acquisition of Credit Suisse, that has provided an important support to a systemically important bank in Switzerland. And here in the US, while deposit outflows have stabilized, there remains some distress in the regional banking sector, including with banks like First Republic and PacWest Bank. Now, a couple of points we'd note here. First, while the recent turmoil in the U.S. regional banks and the acquisition of Credit Suisse may evoke memories of the financial crisis of 2008, we continue to see two very different environments. Large banks in the U.S. are much better capitalized today. They also have more diversified sources of revenue, including capital markets, investment banking, and wealth management. They're regularly monitored by Dodd-Frank regulations, including periodic stress testing. So while volatility may persist near term and this crisis of confidence may take some time to ease, we do not yet see the scope for systemic disruption in the global banking system. Now, secondly, there also may be a bit of a silver lining to some of this global banking turmoil. If lending standards do tighten and some consumer spending does erode, this does put less ongoing pressure on services inflation, which perhaps also supports the Federal Reserve moving to the sidelines earlier than initially expected. And speaking of the Fed, at this past March meeting, we did hear from Fed Chair Jerome Powell on two very important fronts. First, the actions they've taken to support the banking crisis, and second, their ongoing interest rate hiking cycle to combat inflation. Now, this meeting was unique in that the Fed spent time to highlight its role as a liquidity provider to the banking system, not just focus on its inflation battle. Chair Powell noted that the Federal Reserve remains ready to continue to use its liquidity tools to support the banking sector as needed, through means like offering emergency lending and increasing the flow of dollars. Now, while it did acknowledge that recent turmoil in the banking sector may lead to tighter credit conditions and a slowdown in economic activity, it continues to see the U.S. banking system as, quote, sound and resilient. Now, it's also important to remember that the Fed and global central bank actions recently do come at a more rapid pace than what we've seen really in any time in recent history, including the great financial crisis in 2008. Now, the Fed, of course, also focused on its ongoing inflation battle, raising interest rates by 0.25%, in line with market expectations. This brings the federal funds rate to around 5%. Now, notably, the Fed also released a new summary of economic projections and best estimate of rate hikes going forward. As the Fed projections indicate, they see economic growth softening, headline and core inflation likely headed lower, and interest rate hikes that are closer to an end. In fact, the 5.1% estimate for 2023 implies perhaps just one more rate hike remaining. Now, what are the market implications of the banking crisis and this Fed rate hike decision? Well, in both equity and bond markets, we have seen more defensive posturing over the past month. Sectors such as consumer staples and healthcare, which are traditional defensive areas, have outperformed alongside quality growth and parts of technology, which also tend to do well when yields are moving lower. Now, we see this trend persisting near term as this confidence in the banking sector may take some time to fully return. Similarly, in the bond market, we have seen Treasury yields move lower as investors flock to traditional safe haven assets. Both the 2-year and the 10-year Treasury yield are well below recent highs. Now, over time, we do think yields will stabilize, although perhaps the highs in yields are behind us. But nonetheless, while investors more recently have gravitated towards short-term bonds, think about CDs or 1 or 2-year Treasuries, and perhaps rightfully so, as yield opportunities are favorable relative to any time in recent history, we do see opportunities forming, however, to complement these, potentially with longer duration bonds, particularly in the investment grade space. Now, keep in mind, these bonds not only lock in better yields for longer, but also have the opportunity for price appreciation, especially if the Fed does pause and over time move interest rates lower.
With this part of the year often referred to as retirement season, I want to take a minute to talk about cash. Interest rates are higher than they've been in years, and with the markets having a rough 2022 and early start to 2023, there's been a lot of focus on cash and shorter-term investments like CDs. Given the current environment, it could be tempting to either move or to even keep money in cash, so the question becomes, should I be keeping my money in cash or CDs, or should it be invested in something else? Now, certainly cash plays a crucial role as part of your overall financial strategy, but it's important to hold the appropriate amount in order to achieve your goals. But to answer this question, we need to first understand the role of cash and how much makes sense, and then we can determine if this money should actually be invested. In general, cash can serve several purposes. It should be there to provide for your ongoing living expenses, as well as maybe to pay down debt. In addition, we recommend having between 3 to 6 months of living expenses in cash for your emergency fund. Finally, cash can also be used for short-term savings goals. But if the cash isn't needed for those items, if you have your emergency fund and your living expenses covered, then any excess cash should really be targeted for reinvestment within the portfolio to support your goals. Notably, by knowing you have those other needs covered, this can provide you with the confidence to allocate this excess cash towards your goals. So before you decide to move any funds to cash or reinvest into another CD, take these steps. First, what is the purpose of the money and what role is it playing relative to the goals you have? Do you have your spending and emergency cash needs covered? And if so, is this really excess cash that should be invested? If the answer is yes, this would be where we could look for opportunities to invest and make progress towards your long-term goals. Not only could the current environment present some opportunities, with this being retirement season, you can still make contributions for 2022 to your IRAs before the April 18th tax deadline, as well as fund your 2023 contributions. Holding cash is important, but cash is not the solution for money that's really intended for long-term goals like retirement. And while there are risks to investing, there are also risks to not investing, and that's not reaching your goals. Importantly, taking the time to understand the purpose of your cash and its role can help you determine where you should invest it. So reach out to your financial advisor, see if you have your short-term and emergency needs covered, and ensure you're taking the appropriate steps to reach your goals.
So overall, while it does take time for a crisis of confidence to ease, we continue to believe that there are not yet signs of wide-scale contagion or systemic risk in the U.S. banking system. In our view, a modest economic downturn continues to remain the base case scenario, and markets over the past 15 months or so have reflected some or even much of this outcome. We do see opportunities forming both in the equity and bond space in the months ahead and beyond the more recent defensive posturing. We recommend investors work with advisors to continue to use market volatility to rebalance, diversify, and add quality investments at better prices ahead of a potentially more sustainable rebound to come. So with that, I thank you, and I hope to see you back here for the April Market Compass.